Member asks another question. He says, does your software compare between two stocks options, the same out of the money, same percentage from the current price, same number of days to expiration to see which one has a better return? Not directly, but you can set that up. I don't have a field that does that. I could build both spreads in the custom spread tool, or I could build a spread in the custom spread tool, then open a second window and then build it again. Or let's say I wanted to go to bull put credit and I go to search. Now, what we're going to do here is another way to approach this that you want to do it is just on the fly, create a list. Okay, so I'm going to clear out all filters and I'm going to go to lists. And then I'm going to click on create/modify lists. And I want to create a new list here. And we're going to call it comparable puts. And I'm going to use my stocks again that I know that they're near the same price because they're in the Fusion account at Radioactive Trading. MAS, Masco Company, and Berry Plastics. All right, so let's go ahead and create that. And close the window there. It's going to ask me to refresh the page most likely. There we go. Now I have my list created for my two stocks I want to compare. These don't offer weekly, so I'm just going to go directly to May. And what do we want? I want 10% out of the money. I want at least a 5% return. I got to keep this one low. We saw that earlier that these aren't really great candidates for bull put credit spreads. They're slower growth stocks, but good growth stocks. Both are up about 10% from where I entered them. And let's see here. What did you say? I apologize. Same percentage from the current price. Got it. 10% or more. Same number of days. Yep. Set the expiration. And the better return. So I'm just going to look for a start with a 5% return. Now I go to my lists. Sorry, there it is, comparable puts. It's all Berry positions. Okay, let me make a couple of changes here. Option bid greater than 0. Let's just go 7% of the money. Masco's too low volatility. I should have seen that. And I'm just going to go 3% return. Okay. Okay. So similar strikes, but different ones. Looks like other differences. One, there it is. Okay, I'm just going to use these two. Look at these two right here. They're both the May 55s and the May 50s. Masco's at 62.98. Berry Plastics, I keep slipping and saying barrel. Berry Plastics is 62.91. Same rough probability, both 12.5%, 12.6 for 7% out of the money, 88 and 90% probability. Why does Masco have a higher probability at 90% than Berry does with the 55 strike with almost the same stock price? It's kind of because of the difference in volatility. Lower volatility here on average for MAS. So that's why we see a higher probability. And both are the same return, though, at 3.6% for this position. MAS only offers 5-point spreads. That's why we don't see as many in this case. But they're both at 3.6%, both at an 18-cent net credit at midpoint. I could see other ones. Let me increase. Let's go lower here. Let's just go 5% out of the money, but go for a 5% return. Let's see if we can get at the 60s and the 65s in there. Okay, 50, all Berry. Okay, so it's all Berry, isn't it? Okay. Range out of the money isn't really helping us too much. Okay, so anyway, I'm going to shorten it just one last time here, folks, so you can see it. There we go. MAS 60, 50. That's a 10-point. I'd rather not have that. There's my MAS. There it is, 60.55. Berry Plastics, 60.55. Same expiration, 24.2% return on the Berry, 60.55 for May, 18.3 for the Masco. Probability is lower than I would use, but I just use that to set the example there so that you could see how to do it. So I think that's a quick, fast way in this case to go ahead, create a list on the fly of the two stocks you're interested in, put in your basics in that case, and you have the comparison here of the two positions, same strikes, and you can even force this more. You could say the range out of the money, for example, just 3 to 5. So you're just looking at these particular strikes. Again, I like to go further out of the money with a higher probability. That's personal preference as well. Okay, now, great follow-up question here as we're on this also for the comparing of two positions. You posed the question, if you wanted to compare it to two stocks, which one would you choose to do? Okay, so I based my assumption on the fact that you already did the research and analysis on these two positions that you're interested in trading. So you know the stock chart, you know it as well. Your follow-up is you should always go for the one for the higher return. I'd say if you've already done all of your due diligence on the position, we're looking at almost two mirror position stocks here as far as price, strike price goes, and everything else. You could be comparing a $30 stock to an $80 stock or a $200 stock to a $100 stock. I don't know. But if you've already done your research and analysis on those two positions, I'd say yes, go with the one with the higher return for the most bang for your buck. Or, hey, if you're planning on maybe trading 10 contracts of this one, you've already done the research and analysis on the stock, maybe do 5 contracts of this one and 5 contracts of this one. Why not? But to answer your question directly, would I always go for the highest return? That makes the assumption that you've already done the research on those two stocks, which is why you're looking at them. If I haven't, then yeah, I'm going to look at the stock chart here for Barry. And okay, so we've been moving up. MACD just did cross a little bit negative a couple days ago, but was wanting to come back up positive. Been above the 20-day moving average for a good run and have had a nice good run on this stock position. All right, now, Masco. Much more recent growth and uptrend, more of a positive MACD signal continuing on. You may think of that in that case as being more of a risk because it's near a high and maybe you think it's got to ease off, that maybe the RSI is getting high and you think it's got to ease off a little bit. But this chart does look stronger over this last little time frame I'm looking at, okay, as far as a growth goes. And you follow up with another question. The higher return one would have more risk of not being successful. Not necessarily. Again, the probabilities are different on these. The higher return one in this case has a lower probability at the same strikes because it has a slightly higher implied volatility. But this isn't a fair comparison for me to say that because these are both fairly low volatility. Do not, by the way, if you're watching this webinar live or if you're watching this recording later on, do not enter either of these positions as a bull put credit spread at this time, even though the stocks look good. Why? Because they only offer monthly options that are out to May expiration. Both of them have earnings coming up in the first week of May 4th and May 6th, I think, respectively. Don't do a bull put credit spread around earnings because why take the extra chance that a terrible earnings could fall against you before expiration? This is why I'm trading it as a married put and working to hopefully cancel all the risk and bulletproof it before the earnings event. But don't do these as bull put credit spreads right now. So if I checked my box, of course, in the fundamentals for not between now and expiration, no results. So that's what you want to avoid with the bull puts. We're just using this as an example for members' question because they are almost identical stocks right now, very similar volatility, but it does showcase the subtle difference in probability. Does this mean that Berry Plastics is not as safe as Masco? We could say that just based on the raw numbers. We can say that it looks like Masco has had a much stronger stock trend than Berry in this case, okay? And that's what we're looking for. Bernie, quick follow-up back to the chart there. He says, when you're looking at Bollinger Bands, are you using daily chart? No, this is 14, I think. Bollinger Bands 20. The 20-day moving average. That's why I use the SMA 20 with it as well. So that's the 20-day, not a daily Bollinger Band. I don't go that deep. I don't look at that kind of that intense into that. Sticking with the spreads for right now. Chuck, good day, Chuck. He says, do you have an ideal distance for in-the-money debit spreads? Also, can you confirm your ideal expiration of about 23 days? Okay, Chuck, I really don't as far as the debit spreads go. Now, let me explain that. And you said in-the-money debit spreads. As you know, I am prone to use the in-the-money bull put credit spreads, the weekly bull puts that we have in PowerOptions. This is essentially what I look for the positions I mentioned, the returns ranges, probability ranges I look for, and more. If I'm doing an in-the-money debit spread, a parity trade to one of these, so yes, I run my search. I find bull puts that match my criteria. I do exactly what we talked about. Look at the stock chart, company information, more. If I don't know the stock or I'm not comfortable with it, and if I don't like the first one for whatever reason, it's off, I'm just going to the second one, and I'll do my research there. Last step in that research, before I open the spread, is to do what we just talked about half an hour ago. I'm going to go right to the spread chain. In this case, I can link, where is it? Midpoint spread chain. I'm going to link to it right here. And I'm going to see the comparison of the in-the-money bull call debit spread to the bull put credit spread. If it has a higher return, I might go with the bull call debit spread if I feel comfortable, again, that I can get that midpoint. So to answer your question, if I'm doing an in-the-money, high probability debit spread, I'm probably staying in that same time frame, 11 to 14 days, 2 weeks out. I don't know if I'm going 3 weeks out. Let me just take Spotify for an example. That's not what I meant to do. Sorry, folks. Profit and loss chart. Okay, so here's my bull put credit spread, 40-cent potential return off of the 250 spread. Okay, about a 19% true return off a risk of 210. The bull call would look very similar. It might be more bang for the buck. It might not be. 2 weeks out. That would be my preference because that's what's worked for me with the bull puts. I'd look at them almost as parity trades, not add an extra week for the bull call debit. That being said, what I more commonly use a bull call debit spread for is an out of the money position. So at or out of the money bull call debit spread. And I want to go further out in time in this case, at least 30 days. I might go as far as 60 days. I'm going to go to 42 days out. Okay. And with the stock at 279, I might do a 280, 270 spread. It's right at the money, slightly out of the money. What is the advantage of doing this 45, 60-day out bull call debit spread in this case? Because I'm trying to get closer to a 1-to-1 risk-reward ratio. Debit of 525 for a cost of 475. Probability is lower in this case. Okay? The probability is much lower. What I'm looking for is movement upwards on my position. So like we were looking at for the bear put debit spread a moment ago for Robert on GME, is if this stock starts to move up and goes above 280 in the next 2 weeks, I might be able to close this 2 weeks early and get 50% of this expected profit I was looking for. Okay, so I get $2.50. Okay, not 250, excuse me, 280, 285, somewhere in that range. And okay, I didn't make the full 475, but I still made 285 off of a cost of 525. So that's still about a 45% return on the position, 50% return on the position. That's what I'm looking for. And if I can take it early, if the stock does what I want. This is how I personally use debit spreads. Instead of just buying a call and hoping for it to move up, hedge the cost of the long call from time to time with the out of the money bull call debit spread. And I will be 45, 60, maybe even 90 days out in time. Why not do this if this is so good with closer to a 1-to-1 risk-reward ratio, even though we know the probability is only at about 50%, 45%, that the stock might be above 280 here at expiration? Why am I not doing this with bull puts? Well, it's because I don't want the put to be in the money. I don't want the chance of early assignment on that short put. I will stay out of the money, high probability on the credit spreads, shorter term. I'll go at or out of the money on my debit spread, bull call debit spread, 45, 60, 80 days out in time or more, but I'm not expecting to stay in to get the full profit. I'm looking to close at maybe 50% profit if the stock does what I want. So in this case, just me. If I'm doing, I said again, if I'm doing an in-the-money debit spread, in-the-money bull call debit spread with a high probability, I'm keeping it at that 2-week time frame that I use for the bull puts because they are parity trades and that's what's worked for me. I don't think there's anything wrong with going 23 days out. My ideal time is 2 weeks out. But if I'm doing a bull call debit spread with a closer to 1-to-1 risk-reward ratio approach, I'm doing it in this fashion, 45 to 60 days out in time. Earlier on, I'm sorry. So that's the discussion there. Chuck there for the in the money debit spreads. I'd stay 2 weeks out in time. Quick way to short answer that one in this case is to say that there.